Nothing comes before safety, and that's why I'm here. Do you want to know whether FEPI, JEPQ, VOO, and YMAX or SPYI is the best and safest ETF to invest in 2025? Catch their real stats, numbers, and strategies. And of course, safety of these 5 popular ETFs to give you a full comparison and help you decide where to put your money. In this video, we'll explore the performance, risk, and potential of each, looking at how these ETFs align with your investment goals. Starting with FEPI, the Rex FANG and innovative equity premium income ETF. It focuses on 15 big tech stocks like Amazon, Apple, and Tesla. FEPI's strategy revolves around selling out of the money covered calls to generate income from the volatility of these tech giants. As of 2024, FEPI offers an impressive 25.2% distribution rate, one of the highest in the market. But with high rewards comes high risk. The downside is that its aggressive approach can cap your potential gains during strong tech rallies. Now let's move to JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, which has been a favorite among income investors. Since its inception, JEPQ has grown its asset under management significantly and now holds billions in assets as of 2024. This ETF sells covered calls on Nasdaq 100 stocks like Microsoft and Nvidia, aiming to generate income while managing downside risk. JEPQ's covered call strategy has led to an 11.16% annualized return since 2022, though slightly underperforming the Nasdaq 100 index, which delivered 17.12%. VOO is a well-known ETF that tracks the S&P 500 index, and it remains a popular choice for long-term, low-cost exposure to US large-cap stocks. As of September 2024, VOO has a stellar reputation for safety with an expense ratio of just 0.03%, making it one of the most cost-effective ETFs to hold. Historically, VOO has mirrored the S&P 500, which returned over 27.14% in the last year. For conservative investors seeking diversified market exposure, VOO continues to be one of the safest bets in 2025. YMAX, part of the YieldMax fund family, offers a completely different approach. YMAX uses a fund of funds structure that invests in high-yield ETFs, focusing on income generation through option strategies. As of 2024, YMAX boasts a high of 65.75% distribution yield, making it one of the most lucrative ETFs in terms of income. However, with the high yield comes increased risk, particularly in volatile markets where the downside could be significant. SPYI, the newest S&P 500 high-income ETF, also focuses on generating monthly income but through a more balanced approach. SPYI incorporates a call option strategy while investing in the S&P 500, giving investors the opportunity for both income and capital appreciation. As of 2024, SPYI has amassed $1.9 billion in assets and offers a 12.34% distribution rate. Its performance has been solid with a 14.5% year-to-date return as of August 2024, making it a compelling choice for investors seeking income without sacrificing growth potential. Now let's compare the safety profile of these ETFs. FEPI's tech-focused strategy can be risky, especially with its 25.2% distribution rate. While it offers high returns, the upside is capped due to its covered call strategy. If tech stocks experience a strong rally, FEPI investors might miss out on those gains. On the other hand, JEPQ provides more diversification by investing across the Nasdaq 100, and its strategy aims to mitigate some downside risk. But the returns are still lower than a standard Nasdaq index fund. VOO stands out for its simplicity and broad market exposure. It doesn't employ complex strategies like FEPI or JEPQ, but instead tracks the S&P 500, which makes it an incredible safe option for long-term investors. Over the years, the S&P 500 has proven to be a reliable gauge of the US economy, and with a 27.14% return in the last year, VOO is expected to continue delivering steady returns in 2025. YMAX and SPYI, with their focus on options income, are both income-generating machines, but comes with their own risks. YMAX, while boasting an eye-popping 65.73% yield, has a complex structure that may not appeal to risk-averse investors. Its potential for loss is higher, particularly in market downturns. SPYI, however, balances risk and reward by incorporating tax-efficient strategies, giving it an edge for those who want both income and a chance of capital appreciation. In terms of fees, FEPI charges a 0.65% expense ratio, which is higher than VOO's 0.03%, but still reasonable given the active strategy involved. JEPQ comes in at 0.35%, making it more expensive than a typical index fund, but offering a middle ground between active management and passive indexing. SPYI's expense ratio of 0.68% reflects its active management approach, but for those looking for high income, this fee might be worth it. Each of these ETFs offers a unique value proposition. FEPI is ideal for those who want to ride the wave of tech stocks while collecting high income, though the risk is higher. JEPQ's covered call strategy can be a good option for income investors who want exposure to the Nasdaq 100 but prefer lower volatility. VOO remains the go-to for safe long-term investing in the US stock market. YMAX, with its high yield, is for those willing to take on more risk for greater income. And finally, SPYI offers a balanced approach for those who want both high income and potential growth with tax advantages. Choosing the right ETF depends on your individual goals and risk tolerance. FEPI, JEPQ, VOO, YMAX, and SPYI each bring something different to the table in 2025.